Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
Tonight, the Dow Jones dropped for the 8th straight week, first time since 1923. The S&P falls 20% from its 52-week high. Officially, we're in a bear market. And a new survey said Americans will now be paying over $5,000 a year in gasoline, almost double from 1 year ago. We've got that and more tonight on this Friday, May the 20th, 2022. Hi, I'm Andre Laborde. Welcome to Wall Street Wrap-Up on this Friday, May the 20th, 2022. I hope your week went well. Well, anyone who had to get gas for their car this week, you don't need me to tell you that gas prices have been steadily increasing. AAA has the price of gas at the pumps at $4.59 a gallon, which this week means that every state has at least a $4 a gallon gas. And a disturbing report by J.P. Morgan this week reports that gas prices will surpass $6 per gallon nationwide by August. And as a reminder, last week the Biden administration has suspended any new oil and gas leases in the Gulf of Mexico and Alaska as well. But we're in discussions of importing oil from Venezuela and Iran. Well, coming up tonight, if you're an investor and seeking stocks or thinking about investing, you'll want to catch our guest this evening. Scott Nations is President and Chief Financial Officer of Nations Index. He's a CNBC contributor, but he's also the author of a new book called The Anxious Investor, talking about every emotion investors have when investing, whether they're just getting into the game or professionals that have been in the trenches for years. Scott will be with us in just a minute. But first, how did the markets do this week? Well, a last-minute, and I mean a last-minute surge in the Dow and S&P brought the day into the green, but for the week, all the indexes ended in the red. It was the 8th straight week for the Dow to end in the red, and it was the 7th straight week for the S&P and the NASDAQ to be in the red. This week, the Dow Jones ended at 31,260, and it was down 2.9% for the week. The S&P 500, they closed at 3,901, which was down just over 3% for the week. And the NASDAQ, they ended at 11,354, which was down 3.8% for the week. Now, we haven't had many analysts raise their price targets on stocks, but this week, some analysts did raise price targets on selected stocks. Mike Mayo of Wells Fargo Securities has raised the price of Citigroup to a new price target at $70 a share, possibly because Warren Buffett, during the heavy selling last week, was buying Citi hand over fist, and all the tech sectors had been low due to the correction. But Apple is still the best of the rest. Analysts have a strong buy rating on the stock with a new average price target at $189 a share. Last week, we had our guest Mark Mahaney on the show, and he is the tech analyst at Evercore ISI. Evercore has a price target now of Apple at $210 a share. Apple closed today at $137.59 a share. Well, let's get to our guest tonight. This evening, Scott Nations is President and Chief Financial Officer of Nations Index, which is the world's leading independent developer of index and option strategy indexes. Scott's also the author of a new book called The Anxious Investor, and he's here with us tonight. Hi, Scott. Welcome to Wall Street Wrap-Up.
Thanks so much. It's great to be with you.
I want to ask you about the corrections. Do you think that we've finally hit the bottom? Last Friday, we ended up on a high note. And throughout the week, it's been up and down, up and down. What are your thoughts?
I think that it's just impossible to know. If it were possible to know if the correction is over, if stocks are going to go higher or lower from here, then a bunch of mutual fund managers would be beating the indexes. But we know that over time, that's not what happens. So it's impossible to know. What investors should take away, that doesn't mean it's hopeless, Andre. What investors should take away from the volatility that we've seen recently, I would say a couple of things. One, that volatility is the price you pay for all of the excess return that you enjoy from being invested in equities. and you'll make more than you should. You'll be compensated more than that risk should take from you by remaining invested in equities. And the second thing I would say is don't stop. Just because it looked ugly last week, maybe it'll look ugly next week or next month. Don't stop investing. So many of us want to increase the amount we invest in the market when prices are really high. And we stop investing when prices are having a tough time like we've seen recently. Don't do that. Don't do that. If you have a reasonably long time frame, the market will do all of the heavy lifting as long as you invest, continue to invest, and remain invested.
So sort of like to paraphrase Gordon Gekko, is it time to get greedy again?
I would say this: it's always time to continue to invest in the stock market. Andre, we want to think that it's so difficult to invest. We want to think that it's such hard work. It does not have to be. If you continue to invest, even when times look bad, then again, if you have a reasonably long time horizon, you will be more than compensated for the risk you take, and you will end up doing really, really well. As more than one person has said, the secret to success in the stock market is to invest, continue to invest, and don't get scared out of the market.
In fact, you even have it in the book. Risk is the price you pay for the reward you get for investing in the market. And out of 12 months out of the year, you talk about 7 and 5, 7 months of one, 5 of the other. Describe a little bit what you're talking about 7 and 5.
Sure. In order to understand what is really normal in the stock market, and I think that too many investors, they invest for what is memorable, what they can recall. And if you can recall something specific in the stock market, Andre, it is almost certainly not normal. We all know what happened in 1987 or 1929. Why? Because those things were not normal. And so I look at what is really normal so that investors can understand and prepare for that. And it turns out that just a tiny fraction of the trading days are profitable. The tiny fraction, slightly larger fraction of weeks are profitable. When it comes to months, 7 of the 12 months on average will be profitable as far as a major index like the Dow or the S&P is concerned, and 5 will be unprofitable. The thing is that ratio, that is the likelihood that a time period will be profitable, increases as the time period gets longer. So we do even better if we look at 1-year periods or 3-year periods or 10-year periods. But on a monthly basis, just 7 of the 12 of each year are going to be profitable. What matters is that we compound the results for those 2. That is, we stay in the market for a long time, and the return that we get from those 2 net months that we make money in the stock market will compound and compound and compound.
There's a lot of people that are in cash because they're worried right now. There's a correction going on, and I would not be surprised, Scott, if there were still people that were still in cash from the 2008 financial crisis that we had. Well, 2008, I mean, we're talking about 14 years that have just been sitting there. With inflation right now, what are your thoughts of people that are sitting in cash right now and waiting?
Well, and you're absolutely right about people who sold at the bottom in 2009 and never got back into the market. So in March of 2009, the S&P was below 700, and people sold then. Some people sold right then. The S&P is over 4,000 now, and they've missed that entire run, which is it's nearly impossible to save for an education or a retirement if you do that sort of thing. So it is so enticing to want to try and time the market, but we know that it's not possible. Again, if it were possible to time the market, then a bunch of mutual funds would outperform the indexes, and that doesn't happen. Yeah. So a bunch of people sold at the very bottom. The biggest outflows we had seen in decades from traditional equity mutual funds occurred in February and March of 2009 at the very bottom. And those people, we have the fund flow data, those people didn't get back in for years. Well, they were timing the market. They got out at the bottom. They thought they were doing the right thing, but the truth is they didn't get back into the market until it had rebounded substantially. If you put a little bit in every month, continue to invest, that is the best way to have long-term success.
Normally, when interest rates rise, tech stocks get usually hit hardest. And right now, tech stocks have been hit the hardest because we had a 50 basis point raise by the Federal Reserve last month, and there will be more continuing now throughout the year. Well, because tech stocks have been hit so hard, are tech stocks right now a good buy?
Well, I think in general, equities over the long run are going to be a great buy. And you're absolutely right. But and I know you know this, but let's make certain everybody else knows. Just because the Fed is going to raise interest rates between now and the end of the year doesn't mean that will be a surprise to the stock market. Part of the reason that the stock market's had such a tough time this month is it is anticipating those future interest rate increases. So you're specifically talking about tech stocks. Let's look at the NASDAQ 100, which is an index made up primarily of tech stocks. Some of those make a lot of sense as investment options. Netflix has a wonderful franchise and has really been hit by the fact that they've lost some subscribers. Moderna has a wonderful franchise. And there are other names there that make a tremendous amount of sense. I guess my point is that the NASDAQ 100 itself is about 25% below its recent 52-week high. And so if you're thinking about investing, then invest. Why would you want to stop investing and buying stocks when they're on sale?
You talk about fear, and there's different types of fear. Now, you've got the fear of like what we're talking about, of the fear of getting in and losing money, but you've also got FOMO, which is the fear of missing out. So those are two different types of fear. How does an investor, I'll use it this way, how does an anxious investor, overcome fear?
Absolutely. It's a wonderful question. And I talk about I talk about loss aversion in the book. And there's a bunch of research around this. Humans hate losses about twice as much as they like the same amount of gain, which leads us to really do crazy things when it comes to putting money at risk. It's one of the things that causes people to sell at the very bottom. They get to the point where they physically can't take it anymore, and they end up selling at the bottom, like the people I mentioned in February and March of 2009. So the thing is, you have to understand this loss aversion, but you also have to understand that, and it's going back to how often the market's going to be profitable. You have to understand that if you're in the market for a reasonable length of time, again, the market will do all of the heavy lifting. The market will do the work for you, and given a reasonably long time frame, you're going to come out ahead.
I usually sometimes, and Scott, I've used this analogy. Many people own their own home. And for those people that own their home, they buy a home. Well, when you come home from work every day, you don't look at your spouse and go, boy, what a rough day at work. I wonder what the house is worth today. It's only when your spouse says, hey, did you hear so-and-so, our neighbor, just sold their house for such and such? And you go, what? And then you think, well, gee, if they sold theirs for theirs, I wonder what ours is worth. So, but what most people don't understand is that the real estate market has their ups and their downs and their slow periods and such.
And one of the very first biases I talk about in the book is called the disposition effect. And briefly, it's the tendency that everybody has to want to sell their winning investments and hold their losing investments. And the problem here is we tend to pat ourselves on the back with this. We sell our winners and we think, oh, this is wonderful. I'm refusing to be greedy. Or we hold on to our losers and we say, this is fantastic. Pat myself on the back. I'm refusing to be impatient. Well, the fact is that that's really not what's at work. We sell our winners because we want the surge of chemicals. We want the pleasurable feeling that happens only when we realize a profit. So that's what we're greedy for. And in the book, I talk about some research which shows that the winners that we sell end up doing better than what we end up buying to replace them. So we would be better off if we didn't give into that, if we didn't sell our winners. We would be better off if we instead sold those losers. And that's called the disposition effect. And we can do it in the stock market because we can trade stocks. The reason you can't do it with your home is you got to have a place to live. And that's why so many people over 20 or 30 or 40 years end up making so much money by owning their single family home.
Sure. How about you, Scott? I mean, we all have our biases. What are some of the biases in the market that you have?
Well, I spent 25 years as a professional option trader on the floor of the Chicago Mercantile Exchange, Andre. I was one of those guys in a bright red polyester jacket jumping up and down. And so I saw all the biases. I experienced all of them. The one I fall for the most by far is overconfidence. And when it comes to investing, Americans are overconfident in nearly every way imaginable. We're overconfident in our ability to pick winning stocks, to construct a diversified portfolio, to know when to get in and out of the market. One reason we shouldn't be trying to time the market. We're overconfident really in nearly every way that makes us human, and that's the one that I fall for. There's a bunch of interesting research which says that men tend, when it comes to investing, tend to be more overconfident than women, and single men tend to be more overconfident than men in general. What's that mean? It means that those who are overconfident tend to trade too much. They don't trade profitably. They're overconfident about their abilities in general.
Interesting. We had a couple of months ago, we had John Nigerian on. And John, as you were started off in the pits in Chicago, and he was telling us some of the things that were going on in the pits of, with the superstition that if you had a great day with this shirt one day, well, I'm going to wear the same thing. Well, the only problem is you don't wash it, all those 5 to 10 days and such. And when you're around a lot of guys hollering and screaming. So, he told me about a lot of the superstitions that were going on. I remember reading one time about Warren Buffett, and Buffett said that what we should have is like a punch card, and we only have so many punches around that card for stocks, because that way we'd be very judicious and very selective as what we want to buy and also what we want to sell. Would that be a good analogy of having just so many punches?
It's a wonderful analogy, and it goes back to another one of the biases. And this actually feeds into something that what you just said. There's another bias that really was an eye-opener for me, and that's called sensation seeking. We have a bias as human beings to seek new and novel sensations. Many of us get that fix by going to a scary movie or riding a roller coaster or traveling. And unfortunately, some of us get it by trading stocks because it's similar to going to Las Vegas, which is probably the center of sensation seeking. And so way too often, people, as you said, they'll come home and they'll trade stocks simply for the feeling of it, the sensation of it. And that's why people trade. That's one of the reasons people trade too often. You're absolutely right. If all we could ever do was put a little bit of money into the stock market each month and make big decisions very rarely, that is, be able to punch the ticket very rarely and make big decisions, big changes in the way we deploy our money, we would almost certainly be better off.
Scott, how do you get the emotions out of it? We are all, and one of the things, in fact, you even bring it up in the book, is that we're all social creatures. So people will say, did you have any winners, or what do you have as a loser? How do you take emotion out of it?
That's a great point, because there are many social aspects to investing. Professor Robert Shiller of Yale, who ended up winning the Nobel Prize, famously said that investing has largely become a social activity. We talk about it with others, we gossip about it with others, we read about it, and we read about other people. So the social aspect is undeniable, and it also causes problems because, and this feeds into disposition, you want to be able to tell your neighbor or your friend or your buddy about your winners. You don't want to have to own up to having taken a loser. So how do we get emotion out of the system? Well, that's really why I wrote the book. And then I talk about the biases. And I hope what will happen is people will read about one bias, and Andre, maybe they'll say, no, that's not me so much. And they'll read about a second one and they'll say, no, that's not me either. And then they'll read about a third and they'll say, that's one I fall for. And so just a little self-awareness, I think, when it comes to the biases, will be really important. And it was actually in writing the book that I understood how susceptible I am to overconfidence. Another thing that I suggest in the book to overcome some of these problems, if you feel like you have to trade, you just have to make a trade, you have to buy a particular stock, wait 30 days. wait 30 days. If it's intended as a long-term investment, 10 or 20 years, then it's going to be absolutely inconsequential to your long-term returns that you've waited 30 days. But during that period, maybe it will become obvious to you that you're just sensation seeking, or you just want to go along with the herd because the stock has rallied a bunch recently. Waiting 30 days will have no impact on your long-term returns, but it will give a lot of insight into why you want to trade.
We're talking with Scott Nations. Scott is the president and chief financial officer of Nations Options Index, but he's also the author of the new book, The Anxious Investor. We're going to be taking a break, but we'll be right back. We're talking right now with Scott Nations. A scenario. Let's say it's not 2022. Let's say it's 1999. Okay, and you've got some money to invest. All right, you want to get in the market. Now you've got some major great companies out there. You've got Palm Pilot. Now Palm Pilot, for our viewers, okay, has like 70% of the market of the handheld computer. Okay, or you've got Netscape. Netscape is a huge company because they have the browser, okay, that for when you use with the internet. Netscape is huge. You've got AOL. AOL is a big company because you want to get on the internet, and AOL is the way to go about doing it through the internet. But you know what? Let's bring up one more. There was a new company that started up about 3 or 4 years earlier, in '95. Let's say it's Amazon. Now, this is an online bookseller, and the guy who started it, Jeff Bezos, said, look, we're going to be, any profit we're having, we're just going to keep putting it back in to the company. So now you got, let's say Netscape, huge companies, Netscape, Palm Pilot, AOL, and the newbie of the startup company of Amazon. What would you do?
It's an intriguing question, and really quickly, this goes into hindsight bias, another bias that we haven't described, which convinces people that because the previous scenario is now so obvious in retrospect, in hindsight, that we should be able to figure it out now. In retrospect, it seems so obvious that Amazon was the one that was going to win. Well, at the time, as you pointed out, it really wasn't. But now we think it is, and so now we overestimate our ability to pick winners because we trick ourselves into thinking we would have been able to pick it in the past. Very interesting question. What would I do? Well, I would probably turn to an index. I would turn to an index, whether it's the S&P 500 most likely, maybe the NASDAQ 100, and rather than be overconfident in my ability to pick one winner out of that roster of names that you mentioned, I would be confident in the ability, not overconfident, but confident in the market's ability to go up over time. And if I had that approach, then I don't have to torture myself into picking one out of those five.
NFTs are big right now, and also cryptocurrency. And we've talked about Warren Buffett and Charlie Munger. I know their thoughts on the cryptocurrency phase. God, I'm thinking about getting an NFT or a cryptocurrency as an investment for long term.
Well, you just mentioned these wonderful stocks from the internet bubble. There's another phenomenon we haven't discussed, and that's called fantastic objects. And in 1999, some people thought that by investing in these wonderful businesses run by iconoclastic founders, that some of what made those businesses or those founders special would kind of rub off on them if they either used the product or bought the company that those people ran. And again, there's some wonderful psychology. And again, the phenomenon is called fantastic objects. I think that's a little bit what's going on right now. The idea of cryptocurrencies and the blockchain, that's a fascinating topic. And it's really interesting technology. How it's going to end up being a profitable long-term investment, well, that's still up in the air. And so I wouldn't get pulled into the idea that I have to own the Bitcoin or any one of the cryptos, simply because I think the founders or the people involved or the technology or the blockchain is interesting. I'm going to wait and see how they're going to actually pay for themselves. How are they going to be profitable other than the guy who comes after me being willing to pay more? We know what that's called. That's the greater fool theory. If somehow cryptocurrencies can actually end up being a good business and generating income, well, then great. I'll be investing. Until then, I'm not going to buy simply because it's interesting technology.
What's the best investment advice were you ever given?
Start early. And even if you haven't started early, start now. Be consistent and don't get scared out of the market. The market will do almost all of the heavy lifting for you if you will simply meet it halfway and not give in to your biases.
The book is called The Anxious Investor by Scott Nations.
Thank you so much, Andre. It's been a treat. I'd love to come back.
Thanks a lot, Scott. Well, if you've got a question about finance or a comment about the show, we want to hear from you. Make it pithy, make it concise, and write us at andre@wallstreetwrapup.info. And now for a look ahead from the market information for next week. But first, what well-known clothing apparel received a patent on this day in 1873 that millions of Americans wear every day? We'll have the answer in just a moment. Well, what well-known clothing apparel received a patent on this day in 1873 that millions of Americans wear every day? Blue jeans. Businessman Levi Strauss and tailor Jacob Davis received their patent for work pants reinforced with metal rivets. The blue jeans is 149 years old today. Well, Target and Walmart last week missed their earnings estimates, which sent the market down with a fear of a possible slowdown. Next week, Costco and Macy's will be releasing their earnings on Thursday. Costco makes a lot of their revenue from membership that, whether sales or not, their membership is strong. But Costco's parking lots are always full. But we'll see how next week shapes up. And finally, inflation is hitting everywhere. So if you have small children, and this may not be news to you, but even the cost of babysitting has risen. Parents are now looking to cough up over $20 an hour, and in some parts of the United States, cost is up to $30 per hour for babysitting. And to think you were dreading when they would even start to one-day drive. Well, coming up next week, we're going to be talking with the former chairman of the SEC, Harvey Pitt. From Elon Musk's running battles with the SEC to insider trading, and now the new chairman of the SEC adding climate change to their regulations. Well, are they straying from their original mandate? That's next week with the former chairman of the SEC, Harvey Pitt. And as a reminder, we repeat the show on Sunday mornings, but the best way is to set your DVR so you'll never miss an episode. And that is our show for this Friday, May the 20th, 2022. Hope you enjoyed it. My thanks to Scott Nations for joining us this evening, but always it's you. We appreciate you for allowing us into your homes tonight. Remember, follow us always on all the social media, on Facebook, on Twitter, on YouTube, and WYES.org. So, have a great weekend ahead. Have a productive week as well. I'll see you next week. For Wall Street Wrap-Up, I'm Andre Laborde. Remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.